Hey everyone, welcome back to Corporate Decoder, the place where we like to dig into these company filings and see if they are hiding more than accounting jargon. Prepare yourselves because Totaligent Incorporated's latest report is a wild ride with numbers that will make you scratch your head. Let's dive into a company that is trying to reinvent digital marketing with data, but is it working? Or are they just dreaming about a future that hasn't happened yet? Stick around to find out. Also, before we get too deep, if you love getting these insights directly from the source without all the fluff, hit that subscribe button. And hey, we have a growing community on Discord where we break down these reports even further. Jump in through the link in the description. Alright, so we are looking at Totaligent Incorporated's quarterly report, their 10Q filing. This is essentially a financial checkup for the period ending the 30th of September 2025. Let's start by looking at their balance sheet, which is like a snapshot of what the company owns and what it owes. Remember, this is as of the 30th of September 2025 compared to the end of 2024. Right at the top, we see their cash. In 2024, they had over $22,000 in cash. Fast forward to September 2025, and that number has plummeted to just $504. That is a drastic, almost unbelievable drop in cash. It sounds like they are running on fumes. Now look at their property and equipment, which has also gone down from over $66,000 to about $34,000. And capitalized software, which is basically the cost of building their digital tools, it has increased though from nearly $128,000 to over $153,000. So they are investing in their software, but with only $504 in cash, it's hard to see how they will keep that up. And then there is the stockholders deficit. This is typically where the owner's stake in the company is shown. For Totaligent, this number is actually a big negative. In December 2024, it was a deficit of over $1.7 million. By September 2025, that deficit has grown to over $2 million. This indicates the company owes more than it is worth, which is a major red flag. Now let's shift gears to their profit and loss statement. The statement of operations. This tells us how much money they made and how much they spent over a period. For the 9 months ended the 30th of September 2025, they reported revenue of just $22.48. Compare that to the same period in 2024, where they had over $44,000 in revenue. That is a massive revenue drop, essentially almost all of it gone. And look at the 3-month period ending the 30th of September. Gone from nearly $30,000 in 2024 to just $22.48 in 2025. This shows a clear downward trend in their sales, and their gross profit follows suit. In 2024, for the 9 months, they had about $45,000 gross profit, but in 2025, it is the same $22.48 as their revenue. The 3-month period shows a loss of $889 in 2024, and a tiny profit of $22.48 in 2025. This really doesn't paint a rosy picture for their core business operations. Their operating expenses also show a significant decrease from over $772,000 in 2024 to just under $300,000 in 2025 for the 9-month period. And for the 3-month period, it dropped from over $457,000 to $117,000. This spending cut is primarily due to a decrease in personnel expenses and an absence of stock-based compensation to consultants, which seems like they are cutting costs drastically. The result of all this is a net loss. For the 9 months ending the 30th of September 2025, their net loss was a little over $337,000. In the prior year, that loss was much larger at over $834,000. So it looks like they are losing less money, but they are still losing a lot. Next up, a look at their statement of stockholders deficit. This is where we really see the impact of their financial situation on ownership. At the end of 2024, they had a deficit of over $1.7 million. Then after some interesting transactions like conversion of Series D preferred stock into common stock and cancellation of Series D preferred stock, their deficit for the quarter ending March 2025 jumped to over $1.9 million. By the 30th of September 2025, their total stockholders deficit is over $2 million. The significant drop in additional paid in capital and the increase in accumulated deficit are concerning. It essentially shows that the value attributed to their stock has severely decreased. Now, the cash flow statement. This is crucial for understanding how cash is moving in and out of the company. For the 9 months ending the 30th of September 2025, their net loss was about $490,000. And for the same period in 2024, it was over $834,000. So again, they are losing less money, which is a small positive. However, when we look at cash used in operating activities, it tells a different story. In 2025, they used over $226,000 in cash for operations. In 2024, it was about $157,000. So despite the reported lower net loss, they are actually using more cash to run the business. This is a discrepancy that investors should pay close attention to. Interestingly, they received $230,000 from financing activities in 2025 compared to $60,000 in 2024. This suggests they are relying more on borrowing or selling debt to keep the lights on. And remember that alarmingly low cash balance. It is clear why they ended September 2025 with just $504 in cash, down from over $22,000 in 2024. This is a critical liquidity issue. Now let's dive into the notes where companies explain the nitty-gritty behind their financial numbers. This section is critical. The report states that management has concluded that there is substantial doubt about the company's ability to continue as a going concern within 1 year. This is a formal way of saying the company might not make it. They highlight a net loss of almost $500,000 for the 9 months, negative working capital, and a huge accumulated deficit. Their ability to continue depends entirely on getting more money. With only $504 in cash, this is not a small hurdle. They also detail their convertible notes. These are loans that can be turned into stock. Many of these notes are listed as being in default as of the 30th of September 2025. This means they are not paying back their debts as agreed, which is a serious financial problem and likely to lead to legal troubles. When a company defaults on its debts, it can trigger all sorts of negative consequences, from lenders demanding immediate repayment to legal action. The company also shows a derivative liability. These are financial contracts that derive their value from something else, like stock prices. The company's convertible notes have these embedded derivative features. The value of these derivatives fluctuates, and changes in their fair value are recorded as a gain or loss in the income statement. They reported a loss in fair value of derivative liability of over $75,000 for the 3-month period and over $63,000 for the 9-month period. This volatility adds another layer of financial risk. Looking at equity, they authorized a large number of preferred and common shares. However, the number of outstanding shares plus potential shares from convertible notes and preferred stock could exceed the authorized amount. The report vaguely mentions the CEO having enough control to increase authorized shares if needed. This flexibility might be necessary given their current situation. This section is the company's chance to explain their performance. They talk about launching a beta version of their person-based digital marketing platform. They claim to leverage big data to micro-target customers with increased efficiency. Their main business now is managed campaigns for publicly traded companies and political candidates. They want to transition completely to their consumer-facing platform. They describe a system that uses a custom database management platform, or DMP, connected to over 40 network publishers. They emphasize eliminating bot fraud and providing better data insights compared to competitors like LiveRamp. Alright, let's cut through the marketing speak. Totaligent Inc. is in a precarious financial position. Their revenue has collapsed. They are burning through cash at an alarming rate, and they have very little liquidity left. The fact that they are defaulting on several convertible notes is extremely worrying. While they talk about a new digital marketing platform and investing in software, the numbers simply do not support their current operations. They are a small company with what appears to be a significant gap between their grand vision and their current ability to execute. The going concern warning is the most important takeaway here. It means there is serious doubt they will be able to continue operating for the next year. Their future hinges entirely on securing new funding, and given their current financial state and debt defaults, that will be a massive challenge. There are too many red flags to ignore. The steep drop in revenue, the minuscule cash balance, the growing deficit, and the outright defaults on debt paint a picture of a company struggling to survive. The success of their new platform is a big if, and right now that if is overshadowed by more immediate financial crises. So, what is our take? Totaligent Incorporated is a very high-risk investment or venture. They have bold ideas, but the financial reality is stark. The future looks uncertain unless they can somehow secure substantial new funding and turn their operation around very, very quickly. Alright, that is our deep dive into Totaligent Incorporation's latest filing. What are your thoughts on their financial situation and their ambitious marketing platform? Let us know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more corporate investigations. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we will see you in the next one.